Okay, we'll make a start. And as I said, thank you very much, everyone, for joining us today for this webinar where we're going to talk through our latest forecasts and also some of our analysis and judgment we've made at the Scottish Fiscal Commission to support the budget process last week. So I'm Graeme Roy and I'm chair of the Scottish Fiscal Commission. I'm joined by two of my commissioner colleagues, Francis Breeden and David Ulf. We're also joined by the Commission team, so Claire Murdoch, David Stone and Michael Davidson, and they'll be on hand to answer any technical questions or points of clarification. We're going to record the session today, but only the presentations will be, the people presenting will be captured in the presentation, and we'll send a copy around after that. The plan is that Francis will give you some reflections, a broad overview about the work that we have done, and then we're really keen to turn it over to Q&A. So for the Q&A, we'll be using Slido. So if you go to slido.com and type in the code number, so the number that's shown there, then that will take you to the Slido session for this event. Or if you scan that QR code, that will take you to the website to be able to put in your questions, and we'll do our best to get around as many questions as possible. So just before turning over to Francis to give us an overview, I get some quick reflections and broad reflections on our analysis and what we saw last week in terms of the budget. So in terms of tax, there wasn't really much in the way of big major policy announcements in contrast to previous years. The main focus was around freezing thresholds, some of the bottom two thresholds on income tax, some changes in non-domestic rates, and an increase in the additional dwelling supplement for land and buildings transactions tax. But one of the things that Francis will talk about is that the income tax net position, so the difference between the relative income tax performance between Scotland and the rest of the UK, has deteriorated relative to our forecast for last year, largely through a better performance in the UK. So we revised up our forecast in Scotland, but in the rest of the UK, the forecast has been revised up by even more. And what that means is that some of that improvement that we've seen in the Barnett formula, the additional funds flowing through, has been offset by that deterioration in the net tax position. And one of the things, though, we do cover in the report is that while there's been no major policy changes this year in income tax beyond those modest changes I mentioned around thresholds, we are continuing to see the effects of the tax policies coming through over time. So we're seeing the effects of fiscal drag, so more people in Scotland becoming higher rate taxpayers than they were a few years ago. In terms of the policy differential, the changes the government have made still mean that the median taxpayer in Scotland pays ever so slightly less tax than in the rest of the UK. So anyone earning less than around about £30,000 pays slightly less tax, but that slightly less tax is its largest amount at £28 per year, so a very small amount. As we go through the progressive tax system, then people start paying more tax as you move up the higher income distribution, such that someone, say, earning £50,000 pays about £1,500 more. Someone earning £100,000, a very high earner, pays over £3,000 more. We'll talk a bit about Social Security and what we're seeing on Social Security trends. On the policy agenda, we're seeing a continuation of the government's agenda to do several different things. So one is to establish payments that don't exist elsewhere in the UK, so things like the Scottish Child Payment, payments that are more expansive in their coverage than in the rest of the UK, so things like pension age winter fuel payment, and payments that are being designed to offset UK policy decisions, so things like the bedroom tax, and obviously the big one that we had last week around a two-child limit. And then finally, a different delivery mechanism, a different delivery system for Social Security payments that are not only hoping to improve the experience of people accessing Social Security, but also to improve take-up and retention of people on certain Social Security payments. And what we see is essentially a continued trend of that uplift in Social Security taking up more of a share of the overall budget. I should just say, as you know, we didn't cost the two-child limit because it arrived after the deadline of our policy announcements. that we work on for the government. So we haven't formally costed it yet. We will put that cost out on January the 7th, and that'll be backed up by some broader analysis about what that means to the overall social security pot. So that gives you a broad idea of the policy aspects. And what I'll do is I'll hand over to Francis, who'll talk us through some of the analysis on the forecasts and what this means for tax and social security and the overall budget. Francis.
Thanks, Graeme. Yeah, so hopefully that's slides have appeared. First of all, another chance. So we're really here to answer your questions. So another chance to sign up to Slido and put your questions on. So that's the code again and the QR code if you want to scan that. So just search for Slido and that code will get you into this page. Okay, so I'll give you a run through some of the key issues, but obviously not covering everything. I guess the starting point, and this is the total funding that in the budget and the increase from last year. I think one thing, if you regular followers of the fiscal framework, you'll know that a big increase in spending, a big budget like the one we had in the UK, will generally deliver a lot of extra funding to Scotland. Now, for reasons I'm going to go through in this presentation, that extra funding is not as large as you might expect. There are various things that are offsetting that, and therefore, overall, the budget funding is actually quite tight. So as I say, I'm going to explain these as I go through, but here's the overview. So basically, the total funding increase was 4.5% in nominal terms, 2.1% in real. But as I'm going to show you in a second, there was a particular large increase of capital. So that is offset, means there's an offset. There's a slightly lower amount for day-to-day what's called resource spending. So day-to-day on sort of basically wages and salaries and the running costs of government. So as you can see in the next line, the increase for that day-to-day spending is only 3.2% in nominal terms, only 0.8% once you've allowed for inflation. And then finally, as Graeme was saying, the social security system in Scotland is effectively has a bigger commitment, it takes a bigger chunk of the budget than it does in the rest of the UK, and therefore once you've allowed for those social security commitments, there's even less money left over for the normal day-to-day spending. And so after you've taken that social security spending out, you're ending up with a 2% increase in funding in nominal and actually a real terms fall in actual day-to-day spending allowances. So as I say, you might have started thinking that the UK budget would deliver a big slug of funding to Scotland, but once you've taken out various factors, actually the budget is quite tight. Okay, so as I mentioned just a moment ago, the story on the capital side is quite different. So again, as you may have spotted in the UK budget, there was a big increase with a particular focus in increasing capital spending, with the idea that that's the sort of spending that will deliver an increase in the long-term growth rate of the economy. So this is spending on things like roads and buildings. So that big increase in the UK funding for capital did come through as a big increase in funding capital spending in Scotland as well. And so, as you can see in the bottom lines here, the cash terms increase in the spending in funding for capital is 40.7%, and so even after allowing for inflation, that gives you a big 12% increase in funding for capital. So the capital side of the budget, the long-term investment side has had a big boost. The day-to-day spending is very tight. Okay. This next slide just projects forward those numbers, so that those previous numbers are just the increase in this coming budget. Going forward in future years, the big increase in capital spending is a one-off one. It's a one-off levels increase, so the level of capital spending is going to be significantly higher throughout the forecast period than we had before, but we're not expecting big further increases. We're expecting basically a slight real terms decline, but as I say, still significantly higher than it was before the budget. On the resource spending side, the picture going forward is similar to what I've just said. They were not. So there's the real terms cut that we just talked about. So that's the only real terms cut we have, but the real terms increase is quite slow. So over the whole of our forecast horizon, we're talking about a 5% real terms increase in resource in day-to-day spending. So as I say, that part of the budget after allowing for social security spending is going to be remain quite a tight settlement. Okay. Talking a bit about the economy, in the funny sort of way, the economy has not been the story so much, in the sense that our forecast has not changed very much for Scotland. But obviously, one thing that has changed is that the UK fiscal event has been a big increase in spending, and that does read through to a short-term boost in GDP growth. So we've raised our GDP forecast slightly, really much just to reflect that bigger spending in the UK budget. But one thing that's going on in the background, and I'll explain a bit more in a second, is there has been, looking back, an increase in earnings both in Scotland and UK, which was higher than both we and the OBR expected. But one thing that's important, and we'll explain the next slide I'm going to show you, is that the surprise in UK earnings was bigger than the surprise in Scottish earnings. That's to say that they were both revised up in terms of forecast relative to the forecast, but the surprise in the UK was bigger, and that has consequences I'm going to talk to you about in the next slide. Okay, so this is the famous net tax position, which Graeme alluded to. So, as he said, basically what you have is there is a difference between what essentially would have been Scotland's share of UK-wide taxes, so the old block grant idea that that there's taxes raised in the UK, Scotland gets a share of that. Given the way the fiscal framework works, we now know how much income tax the Scotland raises, and the block grant is adjusted for that. And so the net position becomes a difference between the old-fashioned, what's the Scottish share of the UK-wide number, relative to what does Scotland itself raise. And as you can see, before I look at the change, the overall numbers are positive. That's to say, Scotland raises more tax than the UK share of income tax. And that's, as Graeme mentioned, is because the Scottish tax rates, particularly for above medium income payers, are significantly higher, and therefore Scotland raises more income tax than the average in the UK. So the net position is positive and projected to remain positive. But the surprise for this budget has been that big revision down in the net position. And that's basically what goes back to what I said previously. In the UK, there's been a surprisingly high growth in earnings. The growth in earnings has been a bigger upward surprise than we have in Scotland. And even more so when you look at income tax revenues, the surprise in the UK income tax revenue upwards has been much bigger than the surprise in Scottish tax upwards. And that, therefore, because obviously UK taxes affects the block grant position, that explains that big move down in the net position. So we've basically had surprisingly strong income tax throughout the UK, but the non-Scottish surprise has been bigger than Scottish surprise, and therefore has caused this net position to worsen. And that's one of the things that takes a big chunk out of that funding. So when I showed you those initial funding numbers, about 0.6 billion of those numbers was taken out by this upward surprise in UK income tax revenues. So that's the net position. Okay, slightly different theme, but one we all care about: house prices. We in Scotland, and indeed in the UK, and indeed in the whole world, pretty much, have been surprised by how resilient the housing market has been. So I think we all felt the double whammy of the cost of living squeeze plus rising mortgage rates would sort of inevitably mean the housing market would cool significantly. It cooled a little tiny bit, but as you can see in our forecast, so this is where we were before, and this solid line is where we are now. That actually it looks as if the housing market has already shrugged off those two big hits from cost of living and mortgage rates. So it looks as if the housing market is back on its steady rise again, which, as I say, I think for all forecasters is proved a bit of a head scratcher, because you would normally have thought those sorts of big shocks, negative shocks, would actually knock the housing market at least a little bit. Okay. Now back onto Social Security. So as Graeme explained, Scotland spends more on Social Security than the equivalent in the UK, and that's for a range of reasons. Firstly, that the Social Security Scotland is sort of committed to a more accessible Social Security system, which results in higher caseloads, I'm going to show you in a second, but also because of all those new commitments, either to mitigate things that have happened in the UK or to introduce whole new benefits. And so that leads to those little blue bars being above the purple bars. The purple bar is basically how much funding, how much it would cost effectively to deliver the UK version. And this extra bit is about the cost, because Scotland delivers Social Security in a different way. And that's a big and increasing chunk of money over the forecast period that Scotland will spend more on Social Security than the equivalent in the UK. And as we talked about right at the beginning, that obviously reduces the amount available for other types of spending. And just to finish, just to show you that this issue about caseload. So obviously one of the things we've been keeping an eye on is whether the Social Security Scotland is effectively being more accessible and therefore resulting in a bigger caseload. The transfer of Social Security Scotland has been quite recent, and so we've been looking at the data as it's coming in, and it looks very much as if they are achieving what they've been asked to do, i.e. to be more accessible, and therefore caseloads are rising. So this chart shows you for child disability payments how the caseload in Scotland has risen significantly higher than in England and Wales, and therefore it contributes to that bigger cost of Social Security in Scotland. Okay, so that was a run through some key themes, but you're clearly in your questions you don't have to be limited by what I've covered here, but hopefully that gives you a bit of an overview of what has happened. So one last go at the Slido code, and then we'll enter questions. Okay.
Thanks very much, Francis. So
thanks.
Okay, so we've got the Slido questions there, and as Francis said, more than happy to answer any questions on anything that has been covered specifically there, but also in terms of anything that we haven't covered that you want to maybe pick up on. So maybe just to give Francis a bit of a break, I'll maybe come to David to kick off. There's a question there right at the start just about what we're thinking are the main risks to the forecasts, and perhaps maybe you could just talk people through what we're seeing as the main risks, particularly I think around not just the economy, but anything that we're highlighting in terms of the fiscal side of things. You're on mute, David.
Okay, I think one of the main risks we were facing comes from public sector pay and employment. The three elements to this. One is that the government has announced that in terms of pay awards, there'll be a 9% increase over 3 years, with a 3% increase in 25-26. But there are two aspects to that. One is that increase in pay is just pay rates. Pay actually increases faster than pay rates because of people moving up pay grades and pay progression. So we reckon that actually pay cost or cost per person will go up by about 4.5% in 25-26. So the question is whether in the allocations of spending to different categories, health, etc., the government is fully allowed for that 4.5% rather than just 3%. But the other issue here is whether the government will actually achieve 3% pay awards, because we know that there are a lot of pressures on the public sector. We've got waiting times in the NHS, we've got shortage of staff in many areas, So when the government comes to actually try to fill some of those gaps, which are impacting on performance, it may need to pay more than 3%. So that's another potential risk to the forecast. But that comes to another issue, which is staff numbers. Because although the government said it would announce a workforce strategy, that hasn't yet emerged. And we didn't get any figures in the budget documents for what the government thinking was about public sector employment. So if there are all these pressures on numbers in the public sector to try to improve performance in various areas, it could be that it will struggle to hold pay bill down if there are all these pressures on staff numbers. And then the third factor is the increase in employers' national insurance contributions, because that applies to public sector employers as well as private sector employers. And at the moment, we think that the increase in national insurance contributions, employer national insurance contributions, that will fall on the public sector in Scotland to the tune of around 520 to 580 million pounds per year. It depends a bit on how you define the public sector. However, what the government will get back from the UK government to compensate for that will be much smaller. We reckon around 380 million pounds a year. And that's for two reasons. One is, on average, the Scotland's public sector is larger per person than it is in the UK. But also because in the public sector in Scotland, the Scottish government has been a bit more generous in pay awards recently than the UK government. It's a bit more expensive to employ people in Scotland than in the rest of the UK. And that will be partly picked up in the amount you have to pay in employer national insurance contributions. So there is a very big risk, I think, around the public sector labour market.
Thanks, David. And maybe if I could then just bounce on, there's a question from Lynn Williams, which I guess just picks up that a bit more about, does the Commission have any sense of likely impact of employer national insurance changes on the economy and labour market, and likely significant impact for voluntary sector? So maybe I just explain a bit more about what David was saying there about the numbers that were flowing through. So what the budget documents have at the moment is essentially no allocation in them for the national insurance increase, in part because the government don't know yet what funding will flow from the UK government. So any of the portfolio changes you see will have additional allocations in the future for national insurance contributions. We just don't know what these will be yet. What then follows from that, though, I think is and I think Lynn's second part of the question is really important, in that we don't yet know essentially where the Treasury will draw the line around funding to compensate for this increase in national insurance contributions. So they could take quite a restricted, limited view of the public sector, so what is formally classified as a public sector. But that would exclude things like GPs, it would exclude things like third sector bodies, it would exclude charities and the like. So once they decide how rigid they want to be about that definition, that will determine then the funding that would flow to the Scottish Government. And then, of course, it's up to the Scottish Government to decide how much they want to compensate third sector, voluntary sector, charity body, all those sorts of things for any increase in national insurance. So this still has quite a bit to run, and it's probably unlikely to be until well into next year before, first of all, we have the funding flow coming in from the UK government, and then know exactly how the Scottish government is then going to essentially allocate those sources of funds. But maybe, Francis, if I could maybe come to you, maybe on the first part of the question about what's the economic impact of an increase in national insurance changes. So what are the channels through which the increased tax on employers could have an impact upon the economic outlook, I guess, both in the short term and the long term?
Yeah, I mean, it's really, in a sense, very similar to the impact of income tax. Obviously, one of the things about national insurance is it covers a slightly different group, and in terms of it's those in employment. So it has a slightly stronger impact on employment than a similar income tax change would have. So there is a concern there. That's been a concern that's been raised that it has an employment impact. But in a sense, it's, as I say, it's really, you can think of it very similar in its impact to other income tax changes.
Right. Okay. So there's a question here about just a point about UK earnings. Why are UK earnings rising faster when public sector pay deals have been higher in Scotland? So there's maybe a few things to unpack. Maybe I'll have a first shot at it, Francis and David. Maybe you can come back into that. So I think the first thing to say is what we've seen in recent years has been Scottish earnings actually outperforming earnings in the rest of the UK. So we've actually seen a couple of years where Scottish earnings have been ahead of elsewhere in the UK. Now that actually makes up some catch up from earlier years where Scotland was lagging behind. That's what we've seen for the last couple of years. This year so far, the earnings growth between Scotland and UK has been broadly similar. We'll need to wait and see whether that continues through the remainder of the financial year. I think the point that Francis was making and where the division has come isn't so much about the fact that UK earnings have been outperforming Scotland. What's happened is that the forecast of UK earnings have become closer to ours. So the fact is that we were thinking that Scottish earnings would be ahead of the rest of the UK, which is true. But actually what's happened is that the forecast of earnings in the rest of the UK has done even better than what we think for Scotland, and it's just narrowed the gap. So up to this, so far, what we've seen in the last couple of years is Scotland outperforming the rest of the UK, but that gap is narrowed, and that's the reason. One of the reasons why the net tax position has narrowed. And I think one of the big things, again, building on David's point about risks, is what happens in the next few years about that earnings differential between ourselves and the UK really matters for that net tax position, because essentially the kind of key equation that matters in terms of the economy for Scotland's tax position is essentially, can we outperform the rest of the UK in terms of earnings, and crucially high earnings, high quality earnings. If we can do that, then the net tax position will continue to improve. And if we don't, if the UK outperforms us, then that net tax position will not be as strong. Francis, David, I don't know if you want to maybe add.
Yeah, no, yes, I apologise for I didn't make that entirely clear in the talk. You say it's really and it is, it is a really complex part of the fiscal framework that actually a key part of funding and everything else for Scotland is how our forecast compares to that of the OBR. So there's this sort of this dynamic where the forecast errors that we make, the forecast errors that they make, combine to sort of into an issue. So as Graeme says, that what's really happened is, in a sense, our forecast of earnings was closer to what actually happened, and the OBR has got revised up significantly. And that doesn't necessarily mean the actual numbers were different. It just means that the forecasts were different.
Yeah. And just to add that our forecasts of quite rapid growth in earnings in Scotland was backed up by quite a lot of evidence we looked at to suggest that the labour market in Scotland was particularly tight. But with that fiscal boost that's being given to the UK through the budget, we expect the labour market to tighten quite a bit in the rest of the UK as well. And over the long run, you tend to expect wage growth in Scotland to be much the same as that in the rest of the UK. So that factor, which was giving us a high net tax position recently, we do think will gradually dissipate over time, and that will have a negative impact on the budget.
Yeah, and I guess only the final point, just about the point about public sector pay deals, there is a bit of recycling, so that more generous public sector pay deals do lead to higher income tax revenues in Scotland relative to what would have been. But what we have to remember is about 80% of all employment in Scotland is still in the private sector, and slightly more of that in the UK. So actually what happens in the private sector really matters for our earnings differential. There's a really good question there about the links between social security system, taxes, and economic growth. And maybe if I just explain a wee bit about what we do in the short run, and maybe come to Francis and David for reflections on what their long-term effects might be. I mean, essentially in the short run, the way to think about how we capture changes in social security and taxation is largely we look at like the demand side effect on the economy. So what essentially happens is that while if you're spending more money on social security, then that's less spending elsewhere in the public sector relative to what otherwise would have been. And broadly speaking, these effects net off. And similarly, a similar effect happens on taxation as well in the immediate term, the very short term, where you may be increasing taxation on individuals and households, which in turn leading to reduced spending, but you're using that money to spend more on public services or social security. So in the immediate term, the net effect of these effects really balance it out. What of course really matters in the longer term is essentially what we would call more on the supply side effects. So how you might change incentives to work, how might you use that investment in public services. I don't know, David and Francis, whether you want to maybe explain just about some of the channels through which taxation, social security, and I guess crucially capital investment as well could impact on the economy over the kind of perhaps outside our normal forecast horizon.
Yeah, so social security is a tricky. I mean, this whole area of growth is a tricky area in a sense. That's why I'm in the problem of trying to work out how to generate more growth. In social security, there are some channels. So, for example, there's work that says that having unemployment benefit gives people longer to search for the right job. So you get better matching of employees to employment rather than just people grabbing the first job that comes to them. So there are some channels. But it has to be said that overall the research says these channels are tricky and possibly not that strong. And there's a much more solid evidence base for the effect of public investment on growth, where there's a really good paper which I recommend people have a look at recently by the OBR that basically summarizes the literature on how public investment generates long-term growth and has a very good rate of return in terms of I think the average calculation I have is about if you spend 1% of GDP on public investment, you get 2.4% more GDP than you would otherwise do. So it shows that's just a summary of other studies. So I think the link between capital and growth is pretty well established. Social security, there are channels, but they are controversial and quite difficult.
In terms of tax, we do, in our tax analysis, include behavioural effects of the tax system in Scotland relative to that in the rest of the UK. But that's more on the level of GDP rather than on the growth of GDP. So we have what we call behavioural responses to increases in tax in Scotland. And that's based on numbers which are fairly well established in the literature for these type of behavioural responses. So it could be, for example, if somebody feels that they'll be paying more tax in Scotland than in the rest of the UK, they may want to change their residence or their tax residence with that. And normally that would be quite a complicated effect because you'd have to move house, move job, your spouse would have to move, you'd have to get your kids into another school. But in Scotland, you can just nominate a tax resident, and there may be people working in the city, for example, who may have a home in Edinburgh and a pied-à-terre in London, and they can quite rapidly and easily switch their residence for tax purposes. So we take all that into account in thinking about what's the appropriate behavioural response. But it's quite hard to say what is the cumulative long-term effect of this tax differential between Scotland and the rest of the UK. And we will be trying to investigate that a bit more in the future.
Yeah, thanks, David. And I think one thing that we kind of emphasise as well is that people can talk quite a lot about how changes in taxes might impact on them, but actually, do you actually see a genuine change in behaviour? And there's lots of other factors that influence people's decisions to work more, to work less, to where to locate. There's obviously the potential other side of the coin, which is in exchange for changes in tax rates, what are you getting for that in terms of public services and the like? And people make a much more complex decision about their economic behaviours than simply looking at a tax rate. So we try to have estimates about how we think people might respond, but actually there's a lot more things in there about what actually influences people's decisions on a day-to-day basis. There's a couple of really quick questions I'll just take through just to make sure we get through as many questions as possible. There's a technical question here about the two data sets that we use, the labour force survey and the annual population survey. These are the two big labour markets databases in the UK, or statistics in the UK. And for anyone who knows about this, essentially they've been pretty much deemed not fit for purpose for a whole variety of different reasons, largely because of very poor survey responses, but some other technical issues. And the ONS are working up to produce new data sets and statistics, which will start to come in time. Thankfully, it has a bit of an issue for us in terms of our overall assessment of the economy. It's not great that these statistics are not as good as they should be, but it doesn't actually have too much of an impact on our main forecasting element, because we're quite fortunate and we have access to what's called real-term indicators, which are much more up-to-date trackers of things like earnings and the like. So we're able to use those sorts of data sets much more for our forecasting, rather than having to rely on the ONS labour force survey and APS. Fingers crossed these will be sorted in the next year or so, and we'll be able to use them much more with a much more confidence. So there's a question here around the emergency protocols. Will they be used again by the Finance Secretary, given what we've said about the pay and two-child cap limit not yet accounted for? I mean, just quickly on the two-child cap limit, the plan is that's not going to come in until 26, 27, so it doesn't have an impact on next year's numbers. And then the point about emergency protocols, I mean, ultimately that's for the government to manage the budget. But I think David makes some really good points about what we've just highlighted as potential risks on public sector pay. So remember, public sector pay is about half of all day-to-day resource expenditure. So if, for example, some of the issues that Dave was highlighting, that pay negotiations turn out higher than the basic pay award, if you're trying to get progression through, if you're trying to spend more in public services, and that leads to an increase in the workforce, perhaps in the NHS, that increases public sector pay bill costs. Plus, you've also got the national insurance contributions in there. So there are risks in there for the government on public sector pay. And in normal times, you would hope you'd be able to manage them within the year. I guess the question is how significant these pressures might become, means whether or not you might have to more significant changes like we had last year. David, maybe I'll come to you as the former chief economist in HMRC about the government's tax strategy. And is there anything in the tax strategy that impacts upon our work, or I guess general broad reflections on the government's strategy on tax?
Well, the impact on our work is that we basically have to take whatever policies the government announces firmly. So even though it has a strategy, until that strategy is actually realised in terms of specific policies, then we don't do any work costing those policies. So it won't have any impact on our work until it generates real new policies. The problem with tax strategies is that a lot of tax strategies don't capture some of the real problems that economists worry about in terms of tax. So most economists think that transactions tax, like LPTT, are just not very sensible types of taxes. So Paul Johnson from the IFS is consistently railing against those. But my experience is that chancellors of the Exchequer like to have what we regard as odd policies in their locker, just so they can use that as a lever to generate more tax revenue if they need to do it. So the difference between having a strategy and what you actually do in individual budgets, I think, is quite stark.
Yeah, and I think the one thing I think is, as an outsider looking in at the strategy, what we've seen this year on tax is there has been relatively limited movement on tax levers in comparison to previous years, and the government have indicated that in many ways that they are in the tax strategy document there are no intentions to have further bans on income tax or to have changes in rates, and that's where I think the public finances are then relying on fiscal drag, the ability for more and more people to move into these higher tax bands. So it'll be interesting to see how much longer that continues. They've announced it for another 2 years. It'll be interesting to see how much longer it continues after that, and see whether or not there are any changes to that further down the line. Maybe I could come to you, Francis, just around instability in the Middle East and risks down the line. We had it was a broader question we had at committee yesterday, which I thought was quite good, which is, we mentioned risks to the economic forecast, whether it be the Middle East, whether that be the war in Ukraine, whether that be Trump coming in and putting tariffs on things like Scotch whisky and the like. Could you walk through some of the big macro risks that you see looking at the economy and what the effects of these might be?
Yeah. So that's quite a broad question, but I'll have a go. The Middle East and energy. I mean, we've had experience of that. So one thing to say is, as an old-fashioned economist, we also get very excited about oil prices, but nowadays gas is the sort of the key energy price for the UK, and so that's the area to look at. Which, it is related to the Middle East, but less so than oil. But yes, I mean, clearly any instability is a problem. Tariffs, everybody's very nervous of tariffs, and it is pretty well established that less trade it just hurts everybody. So it's going to, if we do get into a tariff war situation, it is a pretty scary one. I mean, that's what basically started the Great Depression. So let's hope that we don't end up there. So that is a big concern, that is not just one-sided, but a whole tariff war begins. I think those are the two big ones that people are concerned about right now. But I think, as probably any forecaster will tell you, the big thing to worry about is the thing you haven't thought of yet, that's just around the corner, and therefore there's probably something else that is really going to cause problems. But certainly, I think there's a right to establish those as the two that are forefront in people's minds right now.
Mm-hmm. Yeah. Okay, thanks, Francis. So there's a question here around elements beyond capital spending that are having an impact potentially having an impact on the economy. I think there are several things just to highlight in general in that. So I think so capital spending is a really big ticket item in this budget to help support the economy over the medium to long term. And one of the things that I thought was quite interesting, what Francis shows is there's a jump up in capital investment next year, and then it declines slightly. There's a couple of things that are quite important to say about that. The increase we're seeing next year is an increase, but it's an increase on plans that were actually cutting capital expenditure from the previous UK government. So capital spending bounces back, but it actually only really bounces back to where it was a couple of years ago. So it's a big injection, but it's actually not a big injection relative to relative recent history. So what that's largely going to do is unlock opportunities to spend on projects that had been mothballed or delayed. And so things like some of the prison estate, some transport infrastructure projects and the like. I think the second thing that's really interesting that the government are doing is that they're obviously planning to maximise their borrowing and capital investment. So again, injecting even more than the block grant is giving them on capital investment. And I think the most interesting bit is what they're planning to do now with the ScotWind funds. So you recall, so ScotWind is essentially the funding that comes into the government, one-off funding from the selling and the granting of licences for offshore renewables. And there was a wee bit of controversy in the end of the summer when the Cabinet Secretary announced that the plan for the government was to use some of those proceeds in order to essentially fill the gap in day-to-day spending within year. And the problem with that from a public finance point of view is that's you're using non-recurring funding for recurring spending, and that potentially just buys you time, but it's perhaps not the best use of long-term investment resources. So what the government are planning to do is to start to use much more of that for capital investment, and they plan to do that next year, which boosts another element of that. And the hope is that a lot of that will go on projects to help either unlock the renewable energy transition, so ports and infrastructure, or used to fund the transition to net zero. So the capital piece, I think, is actually a really important point in where the government are potentially heading in that. In terms of the other things, I mean, there was no real kind of rabbit out the hat, certainly in comparison to the two-child limit, of big announcements in there. Some really interesting things around the commitment to fund the tech scaler initiative. So the whole Mark Logan piece, which I think is quite interesting. There's obviously this new hub being created for offshore up in Aberdeen, which again is not a huge amount of money, but it's trying to sort a problem in the development of that sector for Scotland around the joining up of planning and regulations and things like that to get things moving more quickly. So that has the potential to have positive economic effects. Against that, though, you have obviously trimmings of at least to the core budgets of Scottish enterprise and organisations as well. So in many areas, that comes back to that point that Francis was making early on, that once you take away the big headline increases to things like social security and in the prioritisation of NHS, all other aspects of the budget are under pressure there. So I'm conscious of time. I will try and get through some relatively quick questions. So maybe David and Francis, I'll come to you on the climate change question that we've got here. On ADS, so is the increase in ADS likely to affect the housing market in some way? So that's the additional dwelling supplement. So we think it will raise revenue. We think it will have a minor impact upon potentially putting off people buying second homes, but we think that will, to an extent, will be offset by freeing up the housing market for people to buy homes in the first place, so people who are not purchasing a second home. So that will have an impact at that in the margin. As Francis said, there are many other factors that seem to be going on in the housing market about people wanting to own homes, which are dominating any effects of these policies in there. So that's likely to be something which will be potentially at the margin, but not really significant in terms of the overall housing market. There's a question about employment and unemployment relative to the rest of the UK. Again, just to highlight on that, one of the things that we're seeing is that the labour market in Scotland is quite tight and tighter than the rest of the UK in many ways. So that is putting pressure on hiring in certain key sectors, which from a public finance point of view is leading to higher earners. And that's one of the reasons why we're more bullish on earnings than we were this time last year, which in turn is leading to higher revenues. So on that basis, we think the labour market, at least at a macroeconomic level, is relatively positive. So maybe if I could turn to Francis, David, maybe talk a bit about our fiscal sustainability work. There's a question there about the risk caused by climate change and mitigation and adaptation of that. So as I said, that probably more has to do with our fiscal sustainability work, but it's a really good question.
Okay, so last year we published a report on fiscal sustainability. So this looking at the effects of current policies 50 years ahead. And we were trying to think about the challenges of climate change. Now, one thing we noted in that document was that it was actually incredibly hard to work out what the government was actually spending in the way of climate change. It designated certain parts of its budget as being the positive, negative for climate change, but it didn't break that down into adaptation, mitigation. It's gone a little bit further in the light of our comments this time around by trying to split some of the areas into this is work on adaptation, this is work on mitigation. But again, there's so little detail about what is actually being spent on either adaptation or mitigation that it's really hard to work out what the government is doing. All we can say is, in the light of the work that the Climate Change Committee did, we were forecasting what types of expenditures the government might need to make in the future on both adaptation and mitigation. But most of the stuff we could focus on was just the mitigation, the hitting net zero targets. There's not enough out there at the moment to do serious analysis of adaptation, let alone looking at the impact of damages. That's the impact of climate change that you cannot adapt to. And one of the big issues there is how much all of this will fall on the private sector and how much on the public sector. So if businesses or individuals have their properties affected by flooding, is the government going to subsidise some of the costs of repairing and restoring those buildings? Are they going to leave it to the private insurance market to do that? We know very, very little about what policies the government has in this area. And so we just urge the government to tell us a lot more about what its policies are going to be on climate change.
Yeah, just one small thing to add. I mean, one thing we noted was, with the small capital budget that was around before this budget, I mean, an awful lot of that was having to go to climate change and leaving very little for anything else. So in a sense, that's another reason why this boost capital helps the situation, because it means that climate change, mitigation, adaptation is sort of manageable within the envelope, more manageable within the envelope that they currently have.
Yeah. I think the number we're talking about, over £1 billion needed each year on average over the next 20 years though to hit our net zero target. And if you've only got a budget of £6 billion, £7 billion for capital, that's a lot of that money has to make sure it's really well targeted at transitioning to net zero. Okay, so I'll try and get me through a couple more questions just before we wrap up. There's a question about council tax and how might potential increase in council tax affects the forecast. So council tax lies outside our remit because it's a local government tax. One of the things that's quite interesting though, I think this year, and what the government have done, is that they haven't put out into the negotiations with COSLA any commitment or expectation about what councils might do on council tax. So that's one to watch. Councils in principle can now set quite different rates on council tax if they wish. You obviously heard in recent days some quite chunky numbers coming through from councils in terms of what they might do on council tax. One of the reasons why that is the case is the gearing effect. So councils rely heavily on central government grants for their overall budget. So if they want to increase their total budget by a significant amount, then they have to do quite a lot of heavy lifting on council tax in order to make the difference. So if council tax is 25% of a council's budget, then even just to get a 1% increase in its total budget, it has to increase council tax by 4%. So that's one of the reasons why the council tax is going to be really quite interesting. There's a really good question there about the 30 million Invest to Save fund announced by the Finance Secretary, and will it shift the dial at all? And I was at an event with the Deputy First Minister, and she was asked that explicitly and told it was 0.06% of the overall budget. So what effect could that have? I thought her answer on that was very good, which was, well, actually, I'd be very worried if I was spending more on this, because it seems a bit outlandish, spending lots of money, public sector money, to try and make the public sector more efficient. So she was talking about much more about actual reform within existing budgets and changes in processes and approaches to all of that. So that will be one to watch. And I think the point that we make, not just in terms of the short term, but in the long term, and the Auditor General was very clear on this as well, is that there are big structural changes happening in our society and the economy. We've spoken about net zero. We obviously get demographics as well. We get questions around ill health and rising disability payments. So we need to actually really reform our public services, because the demand on public services is going to increase significantly over the coming years. So the ability to use the existing funds we've got much more effectively and much more efficiently is going to be really, really important, because without that, then it's going to become even more challenging in terms of balancing the books. Michael, if I can maybe bring you in, there's a question here for you, which is very much in your world about the cruise ship levy. So maybe if you can maybe just explain a bit about what that is, and if you're planning to go on any cruises over the next couple of months, then now's the time to do it.
Thanks, Graeme. I think our understanding at the moment is what's planned for the cruise ship levy is that it'll be a local tax, so actually it won't fall within our remit, but we keep sort of a monitoring brief on new taxes and things, and sort of so if there are other new taxes coming down the pipeline where we will be producing forecasts. So one of those is Scottish aggregates tax, which is part of sort of the devolution from UK government, and then also there's a building safety levy coming down the tracks as well. So we're looking at those definitely in the new tax area, but conscious things like cruise ship levy, as that's a local tax, it's not in our remit.
Yeah, and it's very similar. The motivation behind it is very similar to like the visitor levy as well. It's not so much about raising large amounts of revenues at a national level. It's about managing demand at a local level, and then using the revenues that you might get at a local level to invest in the services that are potentially being impacted by these economic activities in there. So it's something which will be very much about trying to manage and use the investments rather than something that's going to raise a significant amount of additional revenues. Maybe try and get one quick question in, just one final question around borrowing. So maybe Claire, maybe if I can maybe come to you about what the government are planning to do around borrowing in particular, and that'll probably take us up to the end of the session.
Thanks, Graeme. So I can see the question, and there's two types of borrowing the Scottish Government can do. One is current borrowing for resource, and one is on capital. On the resource side, the government can only borrow where there is a forecast error relating to the devolution of tax and social security. They can't borrow to fund current expenditure. So the government there has actually reduced its borrowing plans in 24-25 as a result of the large financial uplift we've seen from the UK government in that year. So they're actually borrowing slightly less on the resource side. On capital, the government they've slightly reduced their plans to borrow in the current financial year, but next financial year they plan to borrow the maximum, and that's part of that big uplift that we're seeing in capital funding in 25-26. That's partly funded through borrowing, and then after that the government plan to keep borrowing £300 million a year over the rest of the horizon to fund capital expenditure.
Great, excellent. Thanks, Claire. So that pretty much takes us to the end of the session that we have today. Just a couple of final quick things before we head off. So firstly, a plug for our explainer videos that we have now on the Scottish Fiscal Commission website. So if you're interested in understanding about how all this fiscal framework works, how the budget process works, then there's the team have pulled together some really good explainers where they'll talk you through how different aspects of the budget work, whether it be social security or tax, and they're really good tutorials, really good things to watch in bite-sized pieces and to find out how the system works. Our next publication is going to be on the 7th of January, so a nice early start for us in 2025, where we'll be presenting our estimates, our formal estimates of mitigating the two-child limit. And we'll also be tracing through what that means to the broader social security budget overall. We'll then be moving towards our next publication of our fiscal sustainability report that will look at focus particularly on health and the effects of Scotland's health record in terms of the future long-term sustainability of Scotland's public expenditure. And then we'll be coming later on in the year to publish our usual set of updated forecasts to help to help support the government's scrutiny of its budget and its analysis. So you can find everything on our website, and do follow us on social media where you can find out the latest updates. So just before I go, can I just thank everyone for joining us? I wish you all a lovely Christmas and all the best for the new year, and look forward to seeing you all soon. Thank you.